In the last few weeks, Warren Buffett's Berkshire Hathaway has been dumping billions of dollars worth of Bank of America stock. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. In this video, we're going to talk about why Buffett might be dumping this stake in Bank of America, and also why it's quite surprising, to be honest, for a lot of investors that haven't, dug in further. Because if you know where Berkshire is right now, they are a financial behemoth with around $300 billion in cash and equivalents on their balance sheet, roughly, maybe just a little bit shy of it, between cash and fixed income. And looking at Bank of America, it's not like this is a crazy expensive stock. You're looking at a stock that currently trades around 11 times earnings, and you can see on a market cap basis, the stock really hasn't gone anywhere for the last 5 years. If anything, it's lower than where it traded at the end of 2021. So that's an important data point, around $300 billion market cap. Back at the end of 2021, its stake for Berkshire Hathaway was around $46 billion. So this is close to its peak versus their cost of around $15 billion. So this was a nice 3x plus for Berkshire, looking at this on, one of their top investments, Bank of America. And the question is, well, why is he selling now? Why is Buffett dumping this? Because this is clearly one of Buffett's bets. He previously talked about how he came up with the idea of investing in the Bank of America preferreds while he was sitting in the bathtub thinking about business and investments. And so why is he dumping it now? I mean, especially when you consider that Bank of America as a franchise still seems to be healthy. Number one in estimated U.S. retail deposits, number one U.S. small business lender. They have a number one in advisory practices, financial planning, personal trust assets under management. So a lot of number ones. So some investors might point to the recent results from JP Morgan, where the stock fell about 5%, as they were effectively lowering their outlook, saying, look, with the Federal Reserve cutting interest rates, it's going to be harder for them to generate interest income because it's a lower interest rate environment, arguably, through the second half of this year, or the next 6 months. And as the Federal Reserve starts to lower interest rates, I actually don't think this is the key reason why Bank of America why Buffett has been selling. I think it really comes down to three key reasons. So let's go through these reasons right now. First of all, it's important to recognize that Bank of America has had huge unrecognized losses on their balance sheet. That might come as a surprise to a lot of investors. But if you do a little bit of digging, you'll see that they've invested nearly $500 billion in U.S.-backed agency mortgage-backed securities. And that portfolio has about $100 billion in losses. All in, looking at all the different securities that they've invested in, these debt securities, you can see that they have over $114 billion in unrealized. That means losses that they haven't yet recognized or realized on their balance sheet. So they have a fair value and they have an amortized cost, and they're not necessarily recognizing this yet on their balance sheet when you're thinking about the equity. And this portfolio of agency-backed securities, mortgage-backed securities, this is super long dated. So it's not going to get fixed anytime soon. This is beyond 10 years, yielding around 2%. So even if the Federal Reserve were to cut interest rates by, let's say, 50 basis points or 100 basis points or even 150 basis points, you're still in a realm where these bonds, these agency mortgage-backed securities, are just bad. It's a bad deal for Bank of America, around 2% relative to a much higher interest rate environment. So you're talking about, let's say, $114 billion in unrealized losses versus, as of the second quarter, $197 billion in tangible shareholder equity. So that is an uncomfortable hit to Bank of America. It's important to recognize when you have institutions reach the point where the unrealized losses equal to or surpass the equity in the business, then you're talking about an institution that's insolvent. That is not what you're seeing here with Bank of America, to be super crystal clear, but you are seeing an uncomfortable hit. So that does make investors wonder, could there be, like, let's say, a second punch that could make them even more uncomfortable? Because $114 billion in unrealized losses versus $197 billion, I mean, that's the majority of your cushion getting eaten up by these unrealized losses. So maybe that, these losses lessen in a lower interest rate environment because, these notes or these mortgage-backed securities, were effectively baking in a 2% yield, and it's less painful in, let's say, a 4% environment or 3% environment. But either way, it still is a hit. I think the second key reason is that investors are starting to see a huge uptick in provision for credit losses. And you can see how the provision for credit losses were up about 50% year over year, from 1.1 billion to 1.5 billion. That alone, you might say, you know what, that's just not enough. This isn't that big of a deal. I personally want to know, why are they seeing this uptick in provision for credit losses? Could this be the beginning of sort of a negative cycle? So I go to AI Ticker Chat, I ask, and keep in mind, chat is now completely free to use at AI Ticker Chat. So if you have any questions about any of your US investments, you can ask like, hey, why is this happening? What has management said? And it'll pull from the relevant documents. We're trying to leverage the most cutting edge, powerful AI models available for you now completely for free. So check that out at AI Ticker Chat. So I'm asking, why did the provision for credit losses see this uptick with Bank of America? A couple of things that management called out. First of all, they talk about the change in interest rate environment and in the fiscal stimulus, and now that's starting to fade away. So you're entering more of a normal environment. So they want to prepare for that, where maybe you have less stimulus in the future. They also talked about how there was a noted increase in credit card delinquencies and some uptick in commercial real estate losses. So those are two parts of their portfolio where they're seeing losses, but they want to provide some provisions to safeguard against potential defaults and, the potential impact on their portfolio. They're also modeling for an uptick in unemployment from around 4% currently to around 5% by the end of 2025. So they are trying to say, look, we are preparing for a potential downturn in the economy, potentially worse unemployment. Personally, I look at some of the trends with robotics. You should check out the video about Neo, X1 Technologies, I believe is what it's called, with their robot. That picture, by the way, is, I originally thought that was a man in a suit. That supposedly is a robot, and the abilities are breathtaking. I think in the next few years, you could really see that scale up. Elon Musk has talked about getting to millions of units for Optimus within the next, 4 or 5 years, 5, 6 years. So I think saying, hey, 5% unemployment, there's a real chance that might be on the low side. There is a very real risk for investors to be mindful of. I think it's important to have a full range of possibilities that it's possible you might see a higher unemployment environment in the future. What's that mean for, a loan portfolio like Bank of America with mortgages, office space, and various different types of loans and debt securities? What does that mean, especially when already half of their tangible equity is being eaten up by these unrealized losses on their balance sheet? So I think this is important for investors to think about. I think that's a second key aspect where Buffett's thinking, man, if you do have certain trends like this continue to percolate, or you have a really tough economy where unemployment really shoots higher. Hopefully that doesn't happen. No one's rooting for that. Certainly myself, I do not want to see that outcome. But it's important to be aware that type of event can happen. You could, Bank of America's balance sheet could take a greater hit, which, maybe that causes pressure in the future. How about the third reason? First, in full disclosure, this is not financial advice. Also, just last week, James, a premium member of the exclusive Unrivaled Investing community, shared, this is a direct quote, was very happy to have re-upped my annual subscription, enjoying the contributions and wisdom of this unrivaled community. If you're looking for compelling investment ideas, come check out Unrivaled Investing. By the way, the premium tier subscription rate is going up soon. So now's the time to lock in the favorable pricing. The third key reason why I think Buffett might be selling Bank of America stock, this is something that I think has been going on for quite some time, is the reality that competition is tough. And you can see that the amount of deposits with Bank of America have been shrinking over time. That does reflect that, look, with inflation, with more money in the system, if you're talking about deposits going down over time, that means you're inherently losing market share. And that's what you're seeing here. You're seeing and by the way, they're still paying out close to 0%. You can see, between 0 and let's say a quarter of a percent, less than a quarter of a percent very clearly, both in corporate and consumer banking. You can see deposits shrinking, the interest rate paid quite low. And, it's not surprising to see, their deposits continue to shrink when you have firms, brokerages, banks like Interactive Brokers. That's personally where I keep my funds, how I invest my portfolio through Interactive Brokers, where cash is currently yielding between 4 and 5%. Before this video was recorded before the recent Jerome Powell meeting, so that'll be coming up. I suspect you'll see an impact there, but ballpark, it's currently around 4 or 5% that you're getting on cash versus close to 0 with Bank of America, like I just called out. Another key aspect is that, and by the way, check out the link below for Interactive Brokers. You can see in the description of this video. And so another key aspect that's hurting Bank of America is you can see their net interest income. You can see how this is not increasing. Over the last year, it's been shrinking, which is because they call out, look, it decreased $500 million year over year as higher deposit costs more than offset higher asset yield. So they're in this tough environment where they invested in a lot of low interest rate bonds for super long duration. And by the way, their short-term deposits, those costs need to be higher in order to attract deposits, and it's offsetting the growth in this business. So you're talking about a declining business right now. Maybe it picks up in the future, but right now it's a low growth or declining, contracting business. In contrast, there are businesses like SoFi. I don't yet own the stock, but I've called out, and especially check out my last video, effectively saying, hey, they're winning market share. They don't seem to have the same sorts of balance sheet issues that you have with Bank of America. You see insiders actively buying SoFi shares. So I would say, that's the type of company that's actively taking share. I'm certainly a lot more interested in something like SoFi than I am in Bank of America, even though you might say, well, wait a second, with Bank of America, you have a lot more downside protection in theory because it's trading around book value. But then you need to start thinking, well, wait a second, how much of that book value is there if it's getting eaten up by, potential unrealized future losses? So I hope this video has been helpful talking about why Buffett, despite his nearly $300 billion in cash, he continues to sell Bank of America. He doesn't need to raise more cash. I mean, he's already got loads and loads of cash on his balance sheet. I just think he's putting himself in an amazing position for if there is a recession in the future and the Federal Reserve can't be accommodative like they've been in prior market cycles. Berkshire Hathaway will be in a wonderful position to invest their portfolio. And I think Buffett is looking at the various trends, such as, let's go in reverse order. One is losing market share to competitors that offer better rates. I call out SoFi, I call out Interactive Brokers. See the link below once again for Interactive Brokers. I think another key aspect is the provisions for losses, where, hey, if there's an unemployment picture that gets a lot worse, and by the way, they're seeing some problems with credit card and office space, it's not a, huge red flag. It's just saying, hey, this is trending in the wrong direction. So that's why provisions are picking up. And then, the other key aspect is this very sizable $100 billion plus in unrealized losses on their portfolio that arguably reflects bad management, where they made a sizable bet, nearly $500 billion in securities yielding around 2%, which had a maturity date of over 10 years. So they locked themselves into a bad situation. So not surprising to see Buffett say, you know what, I've had enough of this. If you have a different take on this, would absolutely love to hear it in the comments below. Thanks so much for watching Unrivaled Investing.